Since the start of the year, the dollar has fallen 9%. The global reserve currency is definitely under pressure. And at the same time, bond yields have risen quite sharply, creating a headache for both government and the financial system. In Japan, the recent surge in bond yields and fall in bond prices has caused the Bank of Japan to report unrealized losses of 28 trillion yen, or about $200 billion. A sudden rise in bond yields can cause even bigger problems for highly leveraged banks and hedge funds. The UK pension fund meltdown in September 2022 was a warning of how markets can carry more risk than is first visible. In 2008, the financial system collapsed unexpectedly because bad debts had been hidden and repackaged from view. No one really knew they were there, or perhaps they just didn't want to look under a mattress. But after all those massive government bailouts coming from a taxpayer, new regulations were brought in to supposedly prevent this kind of collapse in the future. But regulating financial markets is a bit like playing whack-a-mole. You regulate bank lending, so markets shift to new types of non-bank lending, which are less regulated, less opaque. In 2023, the non-banking lending sector grew to $250 trillion, or 50% of the market. Venture capitalists, hedge funds, private credit, companies like BlackRock, Apollo and KKR have all taken on the roles of traditional banks. But a recent report by Moody's suggests that this growth of private credit could amplify the next financial crisis because banks are opening themselves to new channels of risk by lending to private credit whilst shifting their assets off the balance sheet. Two lessons of the last financial crisis of 2008 show that regulators are often fighting the last battle, and the banks always get bailed out. Has anything actually changed? And what is the biggest risk to the financial system? Is it overvalued shares, stagflation, a weakening dollar, rising global debt, or growth of risky assets? This uncertainty has definitely made gold an attractive investment in the past 12 months. Do gold investors know something we don't? The world's biggest economy is certainly going through interesting times. For years, the United States has seen its debt steadily rise, but this hasn't really mattered due to huge foreign demand for US bonds, a strong growing economy, and also the Fed buying bonds itself in recent years. But now the Fed is actually offloading some of these bonds, but it comes at a time when tax cuts are causing the budget deficit to rise to 9% of GDP, a really huge figure for peacetime. It means that in 2025, the US will spend an estimated 4.5% of GDP on debt interest payments alone, and that's higher than other countries in the OECD. But of course, there always can be some black swan event which could easily cause this borrowing to be even higher. And in the past decade, we've become used to unexpected crises becoming much more common than usual. Now, concerns over the US budget has led to a rise in demand for credit default swaps, which is insurance against US debt default, not helped by a debt downgrade. But also a further complication is that all the tariff turmoil has caused a sharp drop in confidence and has caused US GDP to fall 0.2% in the first quarter of this year, raising the prospect of stagflation, higher prices, lower output, a central banker's nightmare. Now, it's easy to dismiss this negative growth as a one-off statistical glitch. There was certainly an element of people trying to get around tariffs, but more forward-looking manufacturing surveys do signal a third monthly decline in output in a row. And the change in tariff rates have been quite dizzying, unprecedented, and many firms are struggling to keep up with all the changes and higher costs. Consumers are also unnerved about the prospect of higher prices. Consumer confidence has fallen, and expectations of inflation have risen, and that makes it harder for the Fed to cut interest rates when they fear that inflation may go up even more. Now, it's not just tariffs where there are other warning signs about the world's biggest economy. US shares are relatively overvalued compared to other countries in the world, but also demand for housing is falling quite sharply because high interest rates really make buying a home unaffordable for many Americans. And as well as households, there's a decline in demand from institutional investors. a reflection perhaps that US house prices are at record valuations, price to income ratios, and with relatively high interest rates make it less attractive as an investment opportunity. Now, across the world, we've seen rising government debt. It's not a feature just of the US, but in the US, it's definitely more acute. And a recent budget could cause a massive increase in debt levels, much higher than the Second World War or the Civil War. It would be uncharted territory for the United States. And this has caused a debt downgrade, convulsions in the bond market. The rise in bond yields to 4% on long-term bonds may not sound much, but with US debt interest payments set to rise to 22% of tax revenue, it will be a big deal. Now, in recent years, China has reduced exposure to US treasuries, wanting to hold less US debt, but still 30% of US debt is owned by foreign owners, and this has definitely helped the US to finance its debt. But one of the few tax-raising measures in the recent budget is to tax foreign holders of US bonds. But of course, this will only make it less attractive, and it could cause more foreign selling. US debt has definitely lost its shine as a gold standard for investment. The fall in the dollar, erratic trade policy, rising domestic debt, and now a tax on foreign owners could exacerbate that sell-off of US treasuries, putting more downward pressure on the dollar too. Now, with any financial boom, we do tend to see irrational exuberance, overconfidence, and a willingness to take on more risk. And arguably there's quite a lot of that around even today. 1920s boom in the stock market was partly driven by leveraged investment. 100 years later, and we're doing it all again, there's now a new form of leveraged investment with a boom in the popularity of something called leveraged ETFs. Basically, it gives investors the opportunity to make much bigger gains and, of course, much bigger losses by betting on movement in the stock market. And by the way, gambling has soared in popularity in the United States in recent years, but that doesn't actually include all the, you could say, unofficial gambling of meme coins, EFTs, even stock market futures. We have seen 400 new ETFs launched in the US this year, but regulatory change means there could be a tsunami of ETFs being landed on markets in the coming months. The number could rise to 7,000, and you'll be able to get leverage on pretty much everything. You probably know about Klarna, a service that enables people to buy now, pay later. In 2022, Deliveroo made a deal with Klarna to enable people to buy fast food, pay it later, the ultimate in instant gratification. Last October, Klarna offloaded most of its UK buy now, paid later debt to a hedge fund. So junk food is now the new junk bond. Now, junk food debt is not going to cause a financial crisis, nothing like the mortgage debt of 2008. But at least with a house, you could say you have collateral when you're eating a pizza, that's it. But I think more than anything, it's the addiction to debt which is ruining, especially with interest rates significantly higher than 5 years ago. And if you look at the average debt to household ratio, it's not too bad, but that masks the fact that for many people struggling, US, UK, Europe, many households at the low end of the spectrum really struggling with just getting by. Now, it's not just ETFs, there's also been an explosion in new types of financial speculation. In 2024, meme coins, a digital currency that has no intrinsic value, surged in value from 20 billion to 120 billion, a 500% rise, which is expected to continue. Dogecoin was started as a joke in 2014, but people took the joke seriously, and its value looks something like a roller coaster. The Trump coin was released in January 2025 with a value of $1, and its value soared to $70 before plummeting. The thing with meme coins is that they have no intrinsic value, they're not backed by assets, they can't be used to buy things in shops, and their value largely depends on social media presence, and some of course will lose money by buying at the wrong time. Now, on its own, it's not going to cause any kind of financial crash, but it is indicative of this new Wild West of crypto and relationship with assets. New forms of investing on your mobile phone is just like a big game, and there's a risk of investors overextending, and any kind of losses in the system can soon spread because of the interlinked web nature of the financial system. In the US, households owe a record 18 trillion of debt in various forms. Many are trying to cut back whilst leaning on installment loans for basics. There's a particular rise in student loans, credit cards, and auto loans. Though it is very significant how little delinquencies there are in mortgages, a stark contrast to 2008. Basically, one big change to 2008 is that homeowners are now on 30-year mortgages, which means they're insulated from interest rate rises. It has caused a very stagnant housing market. Nobody wants to sell, nobody can buy, so it's just not really many sales at all. Like 2008, the financial sector is increasingly interlinked, with banks more exposed to private credit and leveraged bonds, and this web of linking can throw up unexpected systemic risk. But at the same time, there are a few points to bear in mind. Firstly, mortgage repossessions are nothing like 2008. The US economy still does have some momentum from several years of fairly strong investment and productivity growth. In fact, US firms are still highly profitable. Profit margins are still well above long-term averages. And if profit levels were to fall back to more close to normal levels, it could make US shares look overpriced. Also, in terms of US debt, although there has been a rise in demand for credit default swaps, this more reflects a concern about breaching the US debt limit rather than any kind of imminent default. The US could easily change its debt trajectory by increasing taxes. Tax rates in the US are really quite low by international standards. However, just because theoretically the US could reduce its deficits quite easily, it might not really matter if there isn't the political consensus to reduce the deficit and or raise the debt ceiling. Finally, although there is a fear of inflation returning because of perhaps tariffs, a trade war, if anything, is more likely to cause deflationary pressures and lower growth. So I wouldn't say it's like 2008, it is very different, but at the same time, there are a lot of warning signs in the bond market, in the stock market, in the housing market, and all the new kinds of financial instruments. We won't really know exactly what's going on there until it kind of hits you in the face with big defaults or problems. Anyway, I hope you found this video useful. Do consider subscribing. Lots more videos on this topic. Some of them go into more detail on particular aspects. Some of them give a broader picture. Cheers.